The Federal Reserve System virtually controls the nation's monetary system. Yet it is accountable to no one. It has no budget, it is subject to no audit, and no Congressional Committee knows of or can truly supervise its operations. Politicians espouse numerous theories about the cause of this country's economic woes. Seldom, however, do these officials look below the surface. The roots of our economic ills can be traced to central banking and our present monetary system. The Federal Reserve claims to manage our money. Instead, it makes our money worth less and less every day. It has generated continuous and worsening business cycles and lowered our living standards.
It's really no different from a burglar in your house wanting to steal your money. That's what the Federal Reserve does. It depreciates your savings, it takes away your economic security, and it ought to be treated as an institution that does that rather than something of alleged benefit. And we really have a choice of what we want in money. Do we want money that's going to be losing its value every year, or do we want money that's going to be gaining in value? If you are happy with your money losing value, then you want the present system. If you want money to increase in value, then you want a gold standard.
What is money? As the good that makes exchange possible, it's the foundation of every economic activity. In the earliest times, people traded goods and services directly. This form of exchange is known as barter.
That is, if a fishing tribe desired to have maybe wheat, which they themselves did not produce, they would seek out other individuals that produced wheat, and then they would exchange there for fish.
But barter had limitations in the marketplace.
Well, actually, people perceived pretty quickly problems with that direct exchange. If you wanted, for example, fish, and you had wheat, but the people who had fish didn't desire the wheat, you were stuck, okay? Unless you went out and found some other good, possibly berries, that everyone in that society consumed. Then you would trade your wheat for the berries in full confidence then that you could turn around and trade the berries for the fish or anything else that you desired.
Eventually, the most widely accepted goods in a society became valued for their use in indirect exchange. Money is simply another name for the most generally accepted medium of exchange. Throughout history, many goods have served as money. Feathers from the Quetzal bird were used for exchange by the Mayan Indians up to the 15th century in Central America. Tea leaves compressed into bricks were traded in East Asia through the 1800s. Wampum shells were money to North American Indians, while early American colonists traded beaver pelts, which had a high value both at home and abroad. Metal coins first emerged in Greece and Asia Minor during the 7th century BC. Gold and silver were valued for their use in beauty and jewelry and the decorative arts. They were durable, easily divisible, and limited in supply. These precious metals also had a high value-to-weight ratio, making them easily transportable.
You might think back, or we can think back to a time when iron was used as money, for example, in Africa. But imagine going into Sears Roebuck and trying to purchase, let's say, a lawnmower for $350. That would take a ton of iron, whereas it would only take an ounce of gold.
In 1536, less than 50 years after Christopher Columbus set foot on American soil, a Spanish mint in Mexico City struck the first coins made in the New World. These silver coins eventually found their way into the British colonies. Great Britain's mercantilist policies deliberately tried to keep precious metals out of America, so the Spanish milled dollar became the unofficial currency. It was often divided into 8 pieces for smaller transactions, hence the term pieces of 8, with 1/4 of the coin being 2 bits. In 1792, Thomas Jefferson adopted the dollar as this country's official monetary unit.
he looked around, he investigated to see what were the American people using as money, and that was the dollar. And so that's why that dollar became the standard of the United States. And we went onto a gold and silver standard and started minting gold coins with the American eagle, $10 gold coin.
Jefferson, in particular, spoke eloquently of the dangers of paper money. During the War for Independence, the Continental Congress printed vast sums of paper money out of thin air to finance the Army. The diluted money supply naturally depreciated to almost nothing, leading to the phrase, "not worth a Continental."
Extremely dangerous.
As early as the 16th century in Europe, goldsmiths stored gold coins for their customers for a fee and issued receipts for the gold to the depositor. Thus began the use of paper as these receipts soon became widely accepted as a means of exchange, since it was easier and safer to use the receipts for significant transactions. This was the origin of banknotes as money substitutes. These first bankers then took this process one step further.
In effect, if the goldsmith had 1,000 ounces of gold and 1,000 ounces of legitimate receipts being held by the depositor of that gold, he could increase his profits by merely printing up another 1,000 ounces worth of receipts and lending them out. Gold.
There was no longer a 1-to-1 ratio of paper to gold. Now there could be 3 or 4 pieces of paper in circulation for every unit of gold in the vault. These bankers were no longer simply storing or warehousing gold for a fee. They were artificially inflating the money supply and loaning out these phony receipts at interest. This system became known as fractional reserve banking and was later transported to the early American colonies. It formed the root of American commercial banking and ultimately the Federal Reserve System.
This is a fraudulent system. It's not allowed in any other business. If you had a grain warehouse that had loaned out the grain it was supposed to have in storage, that's considered criminal. The guy would go to jail. But the banks are the one industry that's allowed to get away with this and to profit from it.
Alexander Hamilton became the first Treasury Secretary, and in 1791 set up the first Bank of the United States as America's central bank to expand the supply of paper money for the benefit of the government and the commercial banks. Thomas Jefferson opposed this view. He saw a central bank as an undemocratic tool of the northeastern banking establishment. It was dismantled after 20 years. The Federal Open Market Committee, now based in Washington, directs the Fed's most important instrument of monetary policy, the purchase and sale of government securities on the open market. To increase the supply of money and credit, that is, to inflate, the Fed buys government securities from a few hand-picked firms with newly created money. To tighten money and credit, the Fed sells securities. In this, it can act on its own discretion. Another device the Fed uses to control the amount of money in circulation is setting the discount rate. This is the interest rate charged to member banks when they borrow short-term from the so-called discount window. If the Fed lowers the discount rate for its loans, commercial banks will likely borrow more from the Fed. This increases the amount of funds banks have to lend. Bank credit thus becomes cheaper, as reflected in lower interest rates on bank loans and credit cards. The increase in funds available for banks to lend also increases the amount of money in the economy. The Fed can also manipulate the nation's money supply by raising or lowering the reserve requirement. Banks are required to set aside a percentage of their deposits as reserves to meet depositors' demands. When the Fed was established in 1913, it cut reserve requirements in half over the next 4 years, doubling the money supply by the end of World War I. But the Fed's real power lies in its monopoly to create money. Although the U.S. was still on the gold standard in 1913, it was quickly eroded as the Fed continued to expand the money supply. The first step was backing Federal Reserve notes by only 40% in gold, allowing the money supply to be increased 2.5 times. The Federal Reserve System adds another inflationary layer to an already unstable banking system. For example, if the central bank has $100 worth of gold reserves in its vaults and a 10% reserve requirement, it can print up $1,000 of new notes and deposits, which become the reserves of the commercial banks. The commercial banks take this $1,000, and if they're required to hold 10% again in reserve, they can multiply the $1,000 into $10,000 through fractional reserve loans. So an inverted pyramid is created with $100 worth of gold or real money at the bottom and $10,000 of inflated paper money at the top. As this $10,000 in new paper money circulates in the economy, it drives prices up, therefore reducing the buying power of ordinary citizens.
When they spend that money, the people who get the new money first and are able to buy products with it benefit, and the people who get it at the end lose, because when they go to spend it, prices have already gone up, and so they're able to buy less. And so there's a transfer of wealth and of power from some segments of the economy to others because of the actions of the central bank. And basically those who benefit are the government itself, big banks, and government contractors, and anybody who's closely associated with the federal government.